All right, well, we've got a nice crowd here in New York, and I'm showing 12:01 Eastern, so let's go ahead and get started. Welcome everyone here in the room and on the web to our REIT Series event on alternative investments in commercial real estate, where we're going to talk about preferred equity and mezzanine debt. My name is Zach Swartz. I'm a partner in our capital markets and M&A practice here at V&E, and I focus on clients in the real estate industry. I'm really excited about this panel today. We've got a lot of great content in the slides. But that said, as we were kind of preparing for this, we all sort of agreed, we'd like this to be a little bit more of an informal discussion, a little more conversational in nature. Let me introduce the rest of the panel. I'll just go from left to right on the slide here. So, of course, it wouldn't be a real estate panel if we didn't have a tax lawyer on the panel with us. So we've got Chris Mangin up here, who's a partner in our tax group based out of our Washington, D.C. office. Chris specializes in tax issues related to real estate funds, REITs, partnerships, and just general investment in real estate. Next, we've got Christy Mazzola, who's a partner in our real estate group based here in New York. If it touches commercial real estate, Christy does it, but including but not limited to preferred equity and mezzanine financing. So, of course, we had to have her on the panel today. And then we're really extremely fortunate to have two clients with us on the panel today. And we've got kind of both the lender side and the borrower side represented. So hopefully that makes for a good conversation. So we've got Brent Abbott, who's the Executive Vice President and Head of Investments for the Real Estate Division of Pacolet Milliken. So that's kind of the lender side of the spectrum. And then Anthony Scavo, who's the Chief Operating Officer at Basis Industrial. So it's more of the borrower side. And since Brent and Anthony were so gracious to come here and join us today, we wanted to give them a chance to talk a little bit more about themselves and where they work, before we get too far into the presentation. So with that, I'm going to advance us a couple of slides here, and then I'm going to turn it over to Brent to talk a little bit about Pacolet Milliken.
Great, thank you, Zach, and thank you for Vincent and Elkins. Thank you. Thanks, Zach, and for the Vincent and Elkins team for hosting us today. My name is Brent Abbott. I lead the real estate investment team at Pacolet Milliken. Pacolet is a private manager of capital that was founded in 2007. Our business was spun out of a large textile and chemical company called Milliken and Company back in 2007. Through that origin, we have a permanent balance sheet, and we have two investment divisions. There's the real estate division that I work in, and then there's a power and infrastructure division that is very focused on renewables. They've got a solar development business. They've done landfill gas to power. They own an electric utility company, which has become very relevant recently with a lot of the demands for electricity. But it's a diversified business with two divisions. On the real estate side of the house, we are focused on three primary product types: multifamily, industrial, and more recently have gotten into self-storage. We do a number of different things. We buy outright for ourselves. We invest in partnerships where we add value to assets, existing assets, and we do development. And within development, these are all partnership-focused opportunities. We've been an LP. We've been a structured finance provider, which is what we're going to primarily talk about today. And then we've also been a provider of co-GP capital in some instances as well. In context of our portfolio, we own over 50 properties and have a real estate portfolio today with an NAV in excess of $1 billion. If we flip forward in the sides, so this slide is just showing some different things that we do within real estate, but there's really an underlying sort of management of our balance sheet that this ties back to. So managing a permanent balance sheet, we're trying to achieve goals for current cash flow, but also for growth and, of course, tax efficiency. As we think about income assets, which is the bottom left of this, those are assets that are mostly purchased for stable and growing cash flow. We achieve growth through development, and then structured finance and re-tenanting or rehab are sort of hybrid, trying to accomplish both goals for cash flow and for growth. On the right side of this slide, you can see our geographic footprint. So we're based in Greenville, South Carolina, which is provides a nice base for covering the Southeast and the Southwest. But we do the Mid-Atlantic in New York, and then have swung over to the West Coast and have been an investor in California, primarily in the industrial product type. If we flip forward one more slide, this slide is designed to just talk about why we find preferred equity and structured finance interesting. The primary reason is it's offered a path for us to earn equity-like returns without taking last dollar equity risk. If I shift to the right-hand side of this slide, this is meant to demonstrate an evolution of capital stacks, really dating back over the last 6-7 years. We all know that lenders have pulled back in proceeds as interest rates went up. Preferred equity migrated south in the stack. Before 2022, oftentimes in deals, you'd find preferred equity groups that were willing to go to, 85% or 90% last dollar basis in deals. We have had the opportunity to come down in the stack and take a little less risk, which has been appreciated on the preferred side. And that means that more common equity has been subordinate to our preferred equity. We have found that the quality of sponsorship has been really high. The groups that are able to pull together 20 or 25% of the capital stack in common equity are folks that, oftentimes are very well capitalized themselves or have access to expansive private capital networks. So it's just been a very good space for us. I don't know, Zach, if you want me to keep going or the order. I guess let me touch on this slide.
Yeah, sure.
This is just speaking to our experience in the space. We've been active in the structured space since 2015. We've invested over $175 million of capital. We've made investments structured as both mezzanine, debt, and preferred equity. Preferred equity has been much more relevant in recent years for a number of reasons, some of which I think we're going to talk about. But just to give folks an idea of our typical deal size, we are typically looking to invest 10 to call it $35 million of preferred equity in a single transaction. We are today sort of looking at last dollar leverage in the 70 to up to 85% range. 85 is a little tougher to get to, but we're still willing to look at those. And we're typically looking to earn 13 to 15% on these investments, anywhere from sort of 2.5 to 5 year hold period. So, we're generally thinking about a 1.4 as a minimum multiple in these types of opportunities.
Yeah, I'm going to jump in. I'm going to try to talk about a few tax points sprinkled in as other folks talk on this panel. But one of the things I wanted to point out on this slide was that Brent talks about having the preferred equity investments typically structured as equity for tax purposes, because that can oftentimes be beneficial on the lender side. But just a couple things to make the audience aware of. There are instances where either the lender or the borrower may want to try to structure one of these instruments as debt for tax purposes. And at least in our practice, we typically see that in a couple of scenarios. One would be when the borrower side is interested in conducting 1031 exchanges and bringing a preferred equity partner in whose equity for tax would turn the property owning entity into a tax partnership, change the ownership for 1031 exchange purposes, which is generally not a good thing. And then also we sometimes see this when we're representing REITs as the lenders, and in particular in deals where it's a sort of a merchant builder type of deal, development for sale. Think things like condo sales, things of that nature. That would be dealer activities for a REIT lender if that preferred equity instrument was treated as actual equity for tax purposes as opposed to debt. Go ahead, Zach.
So thanks, Brent. And maybe now we can turn over to Anthony to hear about basis.
Yeah, thanks, Zach. Anthony Scalvier. Yeah, Basis Industrial, we formed in early 2021. Two of my partners had a company prior to that, MCSL Self-Storage, that was in business since 2012. So we first started branded as that company, and we rebranded as Basis when we started buying multi-tenant industrial. So the company has two verticals. One, we buy multi-tenant industrial spaces. When I say multi-tenant, it's probably different than you think. It's all very small units in buildings that range from 200,000 to 100,000 square feet, mostly through Florida and Texas. We do have some one-offs in Alabama. We do some industrial development, but on a very small scale. And the other vertical is self-storage development, which we are pretty robust in. We have about 2 million square feet either opened, about to be opened, or under development. And that's all up and down the East Coast, if you will. We have some around here in New York. We have some in Florida, there's one in Detroit, one in Arizona. So we're a little bit multi-geographic on that. And that's more driven by where there's a lack of supply and an abundance of demand, and the rates make the property work. So that's a little bit more, call it, it's not geographically specific because of like multi-tenant industrials, because of, call it, tenant-landlord relationships and rental rates. It's more where there's a hole in a donut where we could fit a store that makes sense because there's no supply and a lot of demand. That's where we'll go with self-storage. The multi-tenant industrial stuff is pretty much working best in the Southeast, the Sun Belt, because of the interrelations of the laws of the states. I mean, the tenant landlord laws down there are much more favorable to developers and owners than they are in the other parts of the country. So being that these tenants are small, there's a lot of ins and outs. There's a lot of things that we couldn't be tied up in landlord-tenant court that long. And that's a big advantage in these areas. And that's why we concentrate in them. It's also the growth of population from the COVID migration that went there. We just see an abundance of demand and a lack of supply. The good thing about multi-tenant industrial, it's very expensive to build. So there is a barrier to entry to it. And most jurisdictions or cities are not going to let you build a space that's going to have 40 to 50 tenants with 5 or 6 cars each in today's environment. They just won't do it. So the zoning is also a nice barrier to entry. We have about, the slide's a little old, number 11. We have about 4.5 million square feet. Christie just closed a lot, that's why. So it grew. But so we have about 4.5 million square feet. That's, I think we just did, it's about 50% Texas, 50% Florida. With those other little ones, it's probably comes out to like 95, and the 5% in the other geographic areas. So we have over 1,000 tenants, 75 buildings, about 100 buildings now actually, and I think there's about 1,200 tenants. We bought all that in the last 3 years, so we've been pretty aggressive in this market. A lot of that had to do with, to turn to subject matter at the pref equity, the last 2 big transactions were originally with pref equity, and then with a mezz lender that V&E represented us on. So just to go through capitalization in general on some of the deals, in the beginning, we had one private equity partner. They would come in, give us about 5.5% of the capital stack. That's total dollars, not equity, total stack. We would put in 4.5%, and they would come in with one of their REITs and give us a slice of pref equity that's totally accrued to make up the difference between the bank debt. That was a great arrangement. It was working great. We would have kept doing it. But when the market changed and interest rates went up, you can't just borrow money from a mortgage REIT when they want, now they actually want payments current, when the money was basically free before and we were doing it all accrued. So that changed, and that's what actually brought us to Christie and to the mezz lender. When our partner, when we had some deals on the contract, decided to change the methodology, and we had to find new equity to plug into that gap that we had. That gap was between, call it, 85 to 90%. So we were raising between 10 to 15 to 20%, similar to what Brent said. But we had no pref equity provider anymore to fill in that gap. So we went out to the market, we hired Newmark. They found a pref equity provider who backed out after we started the deal. And we actually found a mezz lender to come in. And I'll just give some business things about mezz and pref, right? Local regional banks like pref a lot more, even if the terms are twice as vicious. They don't know why they do, they just do. Mezz scares a lot of people because it is debt. Even if it has no lien, it has no payment requirements, it has nothing. A lot of people don't like it. We actually lost 2 lender relationships because of it in our first transaction. And these are lenders, we had millions of dollars of deposits within the bank. So there's, a regional bank, that's a lot of money for a regional bank. And just to give the business, and again, it probably makes no sense logically, but there's a lot of credit people at banks that have certain bad dreams about Bez, and some of them have bad dreams about Pref. So if you get that guy on the phone and he's the one deciding it for you, you might just end up there. So that's where we were, and because of the 2 transactions with one mezz lender, we were able to buy another 2 million square feet in the last year. So I think without that availability in the market, we probably wouldn't have been able to raise enough capital, because these deals that we're buying are pretty large, and in the portfolio level that we're buying them, they're even larger. So you're talking about checks of equity at a 52.5% senior debt. It could be $100 million in equity. That's a lot of equity to raise from a small syndicator like ourselves. With an LP, it might be possible, but a lot of LPs also don't want to deploy that much capital that fast. So we were trying to grow fast. We were the first to the market in this little niche part of industrial, so we were trying to do it, right? I think that's, I hit everything about Pref. I mean,
Yeah, no, that's great. That's great. And Anthony, one of the things that you were talking about, you used the word gap, and having to fill a gap.
There's a huge gap.
Yeah, and so I'm gonna just spend a few minutes talking about kind of some of the market conditions that have kind of been present over the past few years that have kind of led to that gap, because there's a lot of borrowers that are facing that problem. So this slide 14 here shows what a lot of people call the maturity wall. And so, according to this is from the Mortgage Bankers Association, you've got about $4.7 trillion of commercial real estate loans outstanding. And almost, around 40% of that, which is nearly $2 trillion, is expected to mature over the next 3 years. And the color coding on this chart actually, breaks it out by asset class, right? So, and what you can see is, a large portion of the loans that are maturing in the next 3 years are in multifamily, office, and industrial. And of course, it's probably not a secret to anyone in this room, particularly office and multifamily, right, have faced some headwinds recently. Obviously, office coming out of COVID, hybrid work, things like that. It seems like there's an article every other day about, foreclosure on an office building or an office building being sold at a steep discount. And then when you kind of turn over and look at multifamily, right, a lot of the loans in those properties were put in place when interest rates were 0 or near 0. And, I think there was like a lot of overbuilding in that asset class, going back a couple of years. And so occupancy has declined. And so you have buildings that are performing less with 0 or near 0 interest rate loans coming due. Even in industrial, I think, at least from my perspective, that's an asset class that's certainly, been in much better shape than office and multifamily. But, this is a report that just came out in August saying, there's a supply glut. So there's been a slowdown in building, slight tick up in vacancy. And so, and I'm also kind of curious, if there's a potential recession, there's a lot of talk about that. What would happen in this asset class?
I just think in industrial, our sector doesn't fall into this just because the multi-tenant small bay sector doesn't really go into this. What happened in industrial, and it happened in a lot of big areas, these people were building the tremendous big box stores from the COVID demand, right? Mm-hmm. Warehousing was up, onshoring was up, and they're like, oh, we'll build now. We're getting it for $5-6 a foot. Let's build more of it. And when they would build 1 million square feet, they would build 2 million square feet. And they would spec half and they'd have a tenant for one. Mm-hmm. You have 20 developers do that. You have 40 million square feet of excess supply in some of these markets. I mean, they killed them, not to be mean. They did this to themselves, a lot of the developers, by building too much of it. Sure. And that's what you have, is these huge boxes just sitting there empty. Okay. And listen, is it good? It's good for me. So, but I mean, it's not really good for the market to have that much supply, but I think sooner or later it's gonna lease up, just because they did build Class A stuff that isn't around. So as these leases come to fruition and come to maturity on spaces that were Class C or Class D, I think you'll have tenants moving into them, especially for the discounts they're gonna get because they're vacant. Right. So I think they'll fill up, and then the other stuff will be reused or made into multi-tenant or something like that. But it's gonna take a long time to fill up that vacancy that they overbuilt. Mm-hmm. And that's all from overbuilding. Because like the supply is, if you look at the demand chart on the people that give out this information, the demand's high. Mm-hmm. Just that some markets were overbuilt so much in the last 2 or 3 years that they overbuilt the supply for the large bay industrial. And it's interesting what happened. I mean, listen, if you're a developer, it makes sense to do that. You're doing the site work, You're allocating your cost over more square footage. It's a better investment, right? And I'm sure 2 years ago in the middle of COVID, people were like, oh, we'll rent it in 2 seconds. And I think that's what a lot of people got caught with that, and that's where they are.
Yeah. Yeah, and I don't think that's also isolated to industrial. I think that happened in other asset classes as well.
Multitude.
Yep.
Yeah, we had a client who historically had done a lot of big box industrial for Amazon, FedEx. They built movie studios, and during COVID, ended up pivoting to buying what was big box retail attached to malls. So like Sears were in bankruptcy. They would buy the Sears and still do one big lease, but they were leasing these buildings to medical office tenants. So you would go in and you would have your general practitioner on one floor, and then you'd have x-rays on another floor, and it was attached to a mall. So Simon was loving us because it generated foot traffic for them. So an interesting pivot from someone who was doing industrial and during COVID just wasn't able to sustain all of that.
So we're 23 minutes into the presentation. I don't know if anyone heard, but there was an interest rate cut yesterday. And we hadn't mentioned it yet, but
This one didn't age well, did it?
it's funny you say that, Chris, because I was actually prepared for that. So, as I was talking about before, you've got loans with very low interest rates that, were put in place at a time, sort of a zero interest rate environment. And even after the rate cut, right, there were great charts on sort of the homepage of the Wall Street Journal yesterday showing that where interest rates are relative to where they were 15, 20 years ago. They're still much higher than they were 15 years ago, much higher than they were 5 years ago. This quote from Jerome Powell here, this is from July. I mean, it's one of the interesting things that came out of the meeting yesterday, right, is there seems to be some disagreement among, on the Board of Governors as to how many more cuts there are going to be in the rest of the year, where interest rates are ultimately going to land, but they're not going back to where they were. They're not going back to near zero anytime soon. So, I think what that means is, higher for longer. We heard this refrain, survive until 25. I mean, that might work for some people, but it's not going to work for everyone. And then this is interesting. I just had to find a way to fit this in here. I read this in a research report that Wolf Real Estate put out a couple of weeks ago. This is actually a quote from the CEO of Dollar General from his earnings call, Q2 earnings call at the end of August. And there's just two really interesting data points in here, really kind of scary and sad interesting points. But they said approximately 30% of Dollar General's customers have at least one credit card that has reached its limit. And 25% of their customers think that they're going to miss a bill payment in the next 6 months. And so one of the things that was kind of mentioned over the past few years, over and over again, was just sort of the resilience of the American consumer, right? I mean, even in an inflationary environment, even with interest rates higher, even with unemployment remaining relatively, or unemployment ticking up, the consumer was doing great. Well, there's signs that are starting to come out, right, that maybe they're, the American consumer is struggling. Is that, indicia of a recession? I guess that remains to be seen. But, I do think that, if there is a recession, the American consumer struggles, that could have ripple effects on commercial real estate. Regional banks have already been mentioned, right? So, it seems like 100 years ago that, we were talking about Silicon Valley Bank and Signature Bank and, all that hysteria. But, commercial real estate played a role in that, in the regional banking crisis. And I think there is no question that regional banks have stepped back from lending on commercial real estate. And, what that means, right, is, you combine, less sources of capital with debt coming due with low interest rates in a higher interest rate environment, less places for borrowers to turn. That's where the gap is, right? And that's where alternative lenders have kind of been able to kind of step in with pref equity, with mezzanine loans and things like that.
I'll add one caveat to it. It really is like a tale of two countries right now with regional banks. If you're down like where we operate in Florida, the Sun Belt, I have loan officers calling me once a week looking for new deals to lend on from regional banks. The deal we did in Armonk, we had to use a more hybrid lender that we used for the thing, because, and this is in a Westchester County, which is an affluent county, rents are high, everything's going well. We couldn't get a regional bank to get the head around developing something, even with an industrial space that was fully leased before we started. It's just where you are, like, in certain parts of the country, it's like doom and gloom. This is gonna happen, CRE's coming. In certain parts of the country, if it's cash flowing and it works, I'll loan money for it. So it's kind of interesting, right? Because I guess the balance sheets are still there to lend. And it's really where they see less risk, because the banks have to lend some of it. So I think a lot of it's that kind of issue where they see that, okay, in these areas where we have growth, they're buying it for a pretty decent basis, right? Should we lend money? But listen, the leverage is still only gonna be 50%, 52% LTC. Maybe you get up to 60% LTV if you're lucky. But so they're being very safe. There's a lot of money in front of them. But I think that there's an appetite for, if the cap rate's there and there's cash flow, that there are regional banks that will lend. But like you brought up, multi right now is like, it's becoming almost like office in certain lenders, which you never heard of before. It was like the golden asset class. You can always build multi and make sense. And a lot of regional banks won't even talk to you. They won't even look at it. They're so scared.
I think just on that point, I think a lot of, banks are managing balance sheets and they're thinking about where they have risk exposure. And a lot of them have the regionals especially have been big lenders towards multifamily construction. And a lot of those loans are remaining outstanding. There have been borrowers that have not wanted to sell their projects, or if it's taken longer to stabilize assets. And so loans have stayed out for longer. And I think that those lenders, as they start to get payoffs, I think they will be back. I don't think, from what we're seeing around the country and within our own portfolio, multifamily, the fundamentals have held up pretty well. We're seeing, strong occupancy, strong lease ups in our development assets. We've had to be responsive in some markets where there has been more supply. We've had to lower rents modestly. We've had to increase concessions, but we're able to fill these buildings. And with rates coming down, all of a sudden the financial covenant test, debt service coverage test, things like that, they're all starting to work a little bit better. And I hope that with rates coming down, we're going to just start to see some loosening in the capital markets. And so maybe some asset sales will happen. And I think as that happens, as loans pay off, I do expect the regionals to be there and to be more active in multifamily. But it's all today, I think, a matter of just managing balance sheet risk.
So I think that, hopefully kind of sets the, stage for kind of where we are with the market and why we're seeing interest in preferred equity and mezzanine loan kind of solutions. So Christy, maybe now would be a good time to kind of take a deeper dive into the weeds onto what those actually are.
Yeah, sure. So we'll talk a little bit at a high level about differences between pref and mezz. And then I think most interesting, we'll get into some case studies. But generally, and most people here probably know all of this already, but pref, we typically see with regularly scheduled priority payments in the waterfall. There's a fixed rate of return and a mandatory redemption date. So similar to a maturity date in a loan, but part of the equity in this structure. Typically unsecured, but still include guarantees, same as a mezz lender would get. So a bad boy guarantee still in place. You commit fraud or steal money, they are still looking to the same guarantors. Remedies, since they're in the equity, typical equity remedies, including forcing a sale of the property, removing the manager. In some deals, we see the pref or even LPs that are on the larger side asking for a redemption right. That we see as fairly punitive. The redemption sometimes can be for the amount of your capital account at par, or sometimes we see for $1 if it was something really bad. So the pref option here we see as sort of a hybrid investment. Mezz, higher rate of return than senior debt. Often we see this with an equity kicker. Anthony will talk about that in the case study. Security, they're getting guarantees, but they're also getting a pledge. So instead of the pref provider being able to force a sale of the property, remove the partner as two options, here the mezz lender would foreclose on the pledge of the interest in the mortgage borrower and step into your shoes. Again, similar to redemption for $1, you're essentially stepping into the borrower's shoes, still subject to the senior loan. Both are subordinate to senior debt. Both typically would require intercreditor agreements. Rarely we have seen investments structured as pref where pref providers have not asked for this, but typically required for both and can be a point of contention, as you'll hear more about in the case studies. But really the most critical things we deal with are tax considerations, mostly because these two options can be structured in ways that produce the same or similar results for a borrower. So mostly driven from a borrower perspective by tax considerations for the provider.
Yeah, and I'll just say a couple points about that. It's interesting, even though these instruments are very similar economically, they have very different tax treatment. With preferred equity, you're a partner, you're getting a K1. With mezz debt, you are a lender and you're getting ordinary interest income. So it's interesting that they can be so economically similar and yet have such disparate treatment. I'll talk a little bit later when we get, I think, into Anthony's case study. I'll have a few words to say about equity kickers, because that sort of goes to the whole issue of whether the instrument that you're dealing with is debt or equity for tax purposes.
So on this topic of pref versus mezz, we worked with Anthony for the first deal where they used what ended up being a mezz provider. But initially, this deal started as a preferred equity deal. We had a term sheet for pref, which we were negotiating. We signed the term sheet. We were waiting for documents. That pref provider pulled out, and we ended up in a mezz debt structure. But Zach, if you want to go to the next slide. So this was, I'll just tee it up a little bit, and then you can talk to us about the business deal. But this was an portfolio of Shallow Bay Industrial. It was 4 newly acquired properties, 2 existing properties that were owned by Basis with senior lenders in place. So the economics of pref versus mezz here were not necessarily too different from our perspective, but the documentation substantially different, and the way that the providers were looking at it were very different. But so what's here on this slide is a summary of the offering that was presented when it was pref initially. Maybe you could talk a little bit about what was offered and what it ended up looking like.
Yeah, so again, just to go back to what I said, so everyone just gets, our first deal, the 2 assets we were refinancing, if you will, and the 4 new assets we were purchasing, the 2 we were refinancing, our original LP was taking out their pref positions in them, reinvesting them as common equity in the new deals. As I said, their pref source dried up, so we had to find a new one. That came in as that. So this was a very confusing deal. A lot of money was moving into different places. And the idea was to take 2 cash flowing assets with the new deals, move the pref equity into common equity, so the equity that we needed to raise was less. Our LP stayed in with us, and we brought in new money, new cash of about, I believe it was about $12, $13 million above the equity, which brought us up to about 19% of the stack or 20% of the stack in total equity. So that was the idea. We shopped this out with Newmark in New York. They brought us a term sheet from a pref provider in the city. What we were asking for originally was the best terms we can with the lowest current pay and the lowest minimum multiple. So when I say minimum multiple, I'm sure everyone knows what that means. It's the minimum we have to pay them back to get them out of the deal, right? So the term sheet we received was for $52 million to $60 million. It was about 14% total interest, with 4% current and 10% accrued compounded annually, which was we thought was a pretty decent deal at the time when interest rates rising. We accepted those terms. So the deal was basically how we structure most of them, even with the mezz lender, is 100% of cash flow, and it's in a covenant. Goes to the senior lender to pay down whatever the debt payment is, not above the debt payment. The minimum debt payment goes to the senior lender, and then 100% of cash flow after operating expenses goes to either the pref provider or the mezz provider. So it's basically, that's the payment. This did have a 4% current pay. In the NOI calculations in their study, we probably had 5%, so they were taking that as a minimum payment. We guaranteed that payment. We were in default without that payment in this structure. It was different than the next structure we'll talk about. and their minimum multiple is a 1.3. So we were going down the path of accepting this offer. This was different than our original partner's pref equity. Our original pref equity partner had no recognition agreement. It was a simple 10-page doc that said if they have major decision rights and if we were bad, they could somehow take over with no real definition of how. So it was a very old school kind of pref equity, because they were in the sponsor too. So it was like they were on both sides of the money. It was a little different, and they felt more comfortable doing that. And their main goal was to get the senior lender comfortable instead of really securing themselves. So that was their main goal. It's a little different, and I think we'll go into that more about the issues with senior lenders. I think that's what Christy and the guys want to talk about. So the pref equity is 80% LTC, 48 months. It was 14%, with 4% current, 10% accrued. There was an origination fee. Yeah, that was right. And then the second deal we ended up with after the pref lender backed out was a mezzanine debt solution of 82.5% with a maximum of 50.5% of senior debt. So they came in with a very complex structure. I don't want to read it to you. You could read it on the slide, the waterfall structure. It was all IRR based. It was very unique, if you will. There was a maximum multiple and a minimum multiple, so they could only get a certain max multiple, and to get them out, it was a 1.6. They also got an equity kicker, which I'm sure Chris wants to talk about how to income and stuff like that.
I've actually got a couple of points. First, on the preferred equity piece with the minimum multiple, wanted to flag something for you guys that my partner Paige and I have run into a couple times in the last year. Those of you that are familiar with modern partnership agreements may know that most of those agreements are drafted with what's called targeted capital accounts, which means in order to allocate the income each year, you assume that the partnership sells everything and allocate the income to get people's capital accounts to match what the business deal is. So that's sort of the background. These minimum multiple concepts started showing up in deals. And generally speaking, the way these work is if the pref instrument stays outstanding for as long as it's supposed to, most of the time you're not going to have the borrower side have to come out of pocket and pay something else for the minimum multiple. But if I'm assuming as an accountant at the end of year one, even though this is supposed to be outstanding for, say, 4 or 5 years, if I'm assuming at the end of year one, in order to do my allocations, that everything is sold, well, then the borrower owes this minimum multiple, and I have to allocate phantom income to the lender in respect to that minimum multiple. At the end of the day, it's a timing issue because you would have more income now and then less income later, but that's sort of the opposite of what we're trying to do for people from a tax perspective. We're trying to have them pay tax later and not pay tax now. And it was particularly frustrating in this case because this minimum multiple payment might not actually ever be received if the instrument's outstanding long enough and is paying the preferred return long enough. So anyway, moral of that story is we were able to get with the accountants in time and sort of put some amending language into the tax allocations. But I just bring this up for you to be aware of, because especially if it gets caught by your accountants, oftentimes it's going to be too late to do anything about it because they're doing the returns, a year to 18 months after the document was signed. And then a little bit about equity kickers. That's sort of a term that's used in the debt context where, you've got either a senior lender or more often a mezz lender, and they want some upside in the deal. If you tried to combine the equity kicker with the debt instrument itself, that's really going to call into question whether the entire instrument is equity or debt for tax purposes. And so we usually have a sort of a set of recommendations we'll give to people to have them not commingle those two things and to have them be respected as separate. And so obviously you want to document it as a separate instrument. You want to have that instrument be separately transferable. you want to try to hold it in a separate legal entity and have it, this one's important, have it to the extent possible, not be coterminous with the loan. So for example, if I'm lending to you and you're also giving me a profits interest in your LLC, you don't want to say, well, you have to pay me out the profits interest on the maturity date of the loan, because that, again, calls into question whether they're truly separate instruments. And so then, you know, when you make a loan like that, you've got something that we would refer to in the tax world as an investment unit. You're making the loan for $100 and you are getting two things back. You're getting the note back and you're getting this equity kicker back. And so somebody's got to put a value, a current value on what that equity kicker is. And if the parties decide that it has value, let's say in my $100 example, it's worth, the equity kicker is worth $2, everyone decides. So what you've got is two things. You've got a loan for 98 that's got OID on it that's going to, you know, accrue back up to 100 over time. And you've got this $2 equity kicker. So you guys can continue.
Chris, could you go into, if they value it wrong, could you explain what happens? Like if the value is too much, it keeps trying to balance forever, right? It will balance longer, right? To get the capital.
Yes, yes, exactly.
And that causes
Exactly.
more problems, right?
That's right.
And that happened with in a couple of deals that we were involved in. It was actually interesting, and it wasn't us, but it is an interesting thing that happens, because I never heard of it before till this deal. And so for people out there, for business terms, if the value of that equity kicker really matters, what you said at day one.
Yes.
It really does.
Yes.
So two other interesting points about the mezz debt on this deal. It's on the slide, but there were no current monthly payments actually due unless cash flow was permitting it after payment of the seniors on all of these properties. So technically, the mezz lender could go for years without seeing anything paid to them when they had advanced you all of your funds up front. So that was a particularly attractive point here, and an interesting concept, because typically in our loan documents, we see there's an event of default if you fail to pay monthly interest. Obviously not applicable here. So a sort of different feature. And then one other interesting aspect was we had 4 different senior lenders over these 6 properties. Getting senior lenders on board with one mezz lender for this portfolio was a really interesting exercise. For the other senior lenders, that means that their property could be doing just fine. There's no default, there's no issue. But if there is a default at a different property, it would entitle our mezz lender to step in and take control of the entire portfolio. So it's not, I would not say this is a typical construct, and I would say it's something that we needed somebody who was flexible as a mezz lender to get on board with this. So the intercreditor arrangements, I'll call them, because we did not end up with intercreditor agreements on every deal, were probably the hardest part of this deal. A couple lenders who had more sophisticated counsel ended up with typical intercreditors, but other lenders with different counsel ended up with really the bare minimum of what a mezz lender could live with. So in the mezz loan agreement, we ended up with provisions saying that in the senior loan agreement, we ended up with provisions saying that the mezz lender was a copy party for notices so that they knew when there was defaults. Maybe they got some extended cure period, but that probably involved us agreeing to a shortened cure period so that the senior lender was not agreeing to something beyond what they were comfortable with. It involved including a change of control being pre-approved upfront by the senior lender. Brett, I know you have talked about having some issues with intercreditors as well. So interested to hear your experience with that.
Yeah, sure. So in all of our deals where we're making structured investments, we're trying to have a recognized relationship with the senior lender, and that can be an intercreditor agreement in a mezz deal or a recognition agreement in a preferred equity deal. What we're really looking for, as you said, it's control rights. If there's a default within the partnership, we'd like to be able to step in and to start to make decisions for the asset. We'd like notice and cure rights. So to the extent something goes wrong, we'd like the ability to try to right the situation and get the property out of default. And a lot of lenders are nervous about that, especially if it's an asset where there's an intensive business plan, it's development or heavy value add, because they see the operating partner as the borrower and the one with the expertise to execute that business plan. Where we've had success is sitting down with lenders and educating them on the team that we've built. We are not a developer, but we have built a team with folks that have worked for development companies that understand construction, that understand how to asset manage development or heavy value add deals. We just have we bring an approach that ultimately we think is protection for the lender. And so that's the key thing that we try to highlight in those discussions. But yeah, these are important agreements from a lender, from a provider's perspective.
And I think we, mostly you, really used that tactic with the senior lenders on this deal, trying to explain to them that they're in a better position because they have our mezz lender as added protection, who can step in and save their property, keep them from foreclosing, which a lot of banks, particularly in the shallow bay industrial sector, probably do not want to do. They don't want to end up managing these properties with a ton of tenants. And so ultimately ended up being successful with some, but had to end up replacing a senior lender who couldn't get comfortable with the concept with some bridge financing.
And this, just it's a relationship lender, just the one that Christy's talking about, that we've probably had almost 60 million loans outstanding with, and $6 million in the bank with them. And they wouldn't even let us talk to their credit officer in person because they were so upset about the mezz that we switched it on them. Like, we voluntarily did that. It was great. I mean, like, the funniest thing is, we're talking to these loan officers. I mean, we were sitting down with the heads of banks, just trying to explain to them, we wanted our old relationship. If we could have it, we'd still be doing it. This wasn't a choice. It was kind of, we had to do it. So we did it. And to get out of it was, I thought it was a credit enhancement to the lender. We tried to sell that. A lot of lenders, like I said previously, it was just no. And that's what we kept hearing. No, we don't want a mezz lender on the job. We don't want a mezz lender on our property. We don't want a mezz lender calling on us. And we were like, you're okay with a preferred equity guy who has a minimum payment and can take over the project? Yeah. I'm like, it doesn't make, there's no real sense of it. And it really wasn't. And thankfully, our mezz lender was willing to come with us to the banks, talk to them. I mean, me and my counterpart at the lender went to Bank United's office close to here multiple times to actually get that deal done to the last week. And they finally agreed to certain terms. There wasn't a true intercreditor agreement, but it was a slightly modified loan doc. I guess they made everyone happy. They really didn't do anything, but it made everyone happy. But they were there and they knew, at least, listen, I'll just give a 2-minute thing about layman's terms. These guys wanted, these regional banks, the guys you're dealing with, they want what they want. If the mezz guy wants to come in, they want him to go sit down and say, okay, I want to take over. What should we do? That's what they want. That's what they really wanted. They thought that's how it would work. And listen, you're a lender. You want some protection. You're giving us $75, $80 million. You want something in documentation saying what's going to happen. They were all like, oh, come see us when this happens. That was their answer to everything. And it was like, yeah, I'm sure they will, but they want it laid out what's going to happen when they see you. And that was a big hill to overcome. And Christie's, I think, making it lighter than it was. That was the hardest thing to do in this transaction by far.
Yeah, it was just, they heard mezz and they were just totally turned off. There were just ridiculous arguments about certain provisions, even just putting it into the senior loan agreement. The last issue was whether we could add our mezz lender as a notice party to the senior loan. And this one bank said, we refuse to add them. And it ended up being a funny result because the next sentence said, on 1 business day notice, you can change your notice parties at any time.
To anyone.
Next day.
To anyone.
The next day, we sent a change of notice, change of address notice, added the mezz lender, and all was fine. But we ended up in our mezz loan having a covenant and an event of default that said, if you don't add us as a notice party within 5 days, you're in default. But just, it was just all, just hearing mezz, they were totally done, and that was it.
So I want to make sure we give Brent some time to talk about his case study. So Brent.
Okay. So before I jump into this specific example, we are seeing sort of three primary varieties of need for preferred equity or mezzanine debt in the market today. One is from development projects that want to move forward. Two is or acquisition opportunities, folks that think that this is a good vintage to pick up assets. And those can be, more core plus in profile, or could be more opportunistic where they've got a value add business plan. The third category is more broad. It's gap financing, and that's what this case study is going to be about. Gap financing could just, it can cover a lot of different things. There are a number of projects that need capital infusions these days, and those could be related to the performance of the asset. It could be going through a refinancing where their property's coming up short on generating enough proceeds to get to cash neutral. It could be partnership issues. It could be a number of things. But this example right here is a gap equity example. And this is an asset in Atlanta that is a development property. It started construction in 2019, and during COVID, had the reaction that a lot of projects did. It slowed down, started experiencing cost overruns, supply chain issues were becoming a problem. And so this was actually a one asset and a multi-property gap financing pref recap for us. But the situation was that there was a capital need that emerged, and the operating partner and their LP partner did not want to infuse the capital. It was a very uncertain time. This was 2020 when they came to us with this capital need, and so they didn't want to put more capital in, and so there was a gap in the capital stack that they were trying to fill. The equity that we were contributing was minority in terms of dollars compared to what the GP and the LP had in the deal, but the preferred, coming in as preferred equity gave us the rights that we needed to be comfortable making this investment. So we came into this deal. This was a lower leverage pref deal. Our last dollar basis was at 65% of cost. And so we felt like, even though that there was a lot of risk and a lot of unknowns at the time, we felt like at that basis that this is something that made sense. So we moved forward with the deal. It paid off relatively quickly. This is getting into the point about a minimum multiple. This one property, others in the deal did not pay off subject to the minimum multiple, but this one did. And so a minimum multiple, sort of thinking about it simply, is just it's prepayment protection from a lender's standpoint. And so the IRR on this one sort of outperformed our expectation, but that was really about a sort of a shorter hold period. And then I'll just finally make the point on this one that we did get a recognition agreement with First Horizon Bank, and it's the same thing that was described. We needed to go in and talk about who we were and our approach and the way that we were going to be asset managing and construction managing the project. We had to talk about if something went wrong, the steps we would take. If something went wrong during development, what steps we would take, who we would, want to use as the manager, the property manager, if it came to that. And so when we talked through those things, it sort of got the emotional response that Anthony, you were describing to sort of not be the prevailing sentiment that dictated how the lender behaved. So this was a successful transaction, but I highlight it because gap financing is still very much a need in the market today.
So we've got 5 minutes left. There's no humanly possible way we're going to get through the rest of the slides here, but we do have some slides on, in light of sort of the need to fill this gap. We've really seen an uptick in sort of prospective sponsors of vehicles who would look to deploy capital into, from the sort of the lender side, into preferred equity and mezzanine debt financings. There are slides in here, sort of the options that you might pursue for a vehicle. So there's sort of a high level view of a closed-end fund here, right? So defined fundraising and investment period, fixed fund term, typically limited ability to withdraw if you're an investor in a vehicle like that. But you get your capital back, on sort of a fixed date. Open-end funds, closed-end funds are certainly more common in the real estate space. They make more sense where the assets are sort of illiquid. Open-end fund, there's sort of no defined fund term necessarily. And so there is typically an ability for the LPs to get their money out through some sort of a redemption program that's typically subject to gates. No more than X% of the fund's capital can be redeemed in a calendar quarter, things like that. We have had real estate clients asked about doing or explore doing open-ended funds. I think they can work if you have a vehicle where there's a lot of cash flow, so that you can satisfy redemption requests if they come in. But again, you'd certainly want to be protected with a gate. And then of course it wouldn't be a REIT series if we didn't mention REITs, right? So we do have a number of private REIT clients, including private REITs that are pursuing preferred equity, preferred equity mezzanine debt lending strategies. A REIT is sort of similar to an open-ended fund in that there's no restriction on fundraising or sort of like a defined termination date. They can also offer sort of redemption programs like you would see in a typical open-ended fund, subject to a gate. I mean, some of the large non-traded REITs, the B REITs and the Starwoods of the world, they've been in the news over the past 18 months or so because they have those redemption programs and they've received redemption requests in excess of their gates. But I think probably Chris and Paige are, some of the best people on the planet to, we get a lot of these questions from sponsors who come to us and say, I want to do a private REIT. And we say, this slide outlines all the restrictions that all the hoops you have to jump through to qualify for REIT status. And so sometimes the advice, right, is you may want to do a REIT, but maybe not right now.
Yeah, the biggest issue across clients who are in the REIT space and are looking to be in this as a lender, particularly in the preferred equity space, the biggest issue, bar none, is dealer sales, where the borrower has a business plan to develop and sell immediately or almost immediately. And you will find in real life that getting the borrowers to agree to hold the property for a couple years after there's a certificate of occupancy is a very hard thing to do. So that's where you wind up certain times, maybe trying to structure an instrument that's debt for tax purposes so that you don't have that issue. But definitely if you've got a REIT as a client, or if you are borrowing preferred equity from a REIT, that's a hot button issue to look out for.
Thank you all for coming, and thank you all for joining on the web.
Thank you.